Okay, it's 10 o'clock. It's my pleasure to welcome everyone to the CFM Columbia PER Zoom event on alternative data in crypto markets. I'm Harrison Hong, a professor of economics here at Columbia University, and it's a real pleasure to introduce you today to our lecture. Igor, Associate Professor of Finance at the London School of Economics. Igor has done some of the early influential work on cryptocurrencies in finance. Among them are his highly cited paper on arbitrage in cryptocurrencies. He also has a stream of research really on this issue that he's going to share with us today. Before I turn it over to Igor, let me introduce you to Adam Reg at CFM, who will say a few words about the CFM PER alternative data initiative. Adam?
Hello, everyone. CFM PER Alternative Data Initiative has been launched because of how important alternative data has become in investing and economics. The joint initiative enables PhD students to use alternative data sets in their research projects and provides a platform for cross-collaboration between academics and investment professionals. While many of the alternative data sources are novel and previously unexplored, it is important to maintain the same high standards of academic rigor when examining their usefulness in explaining stock market and economic phenomena. Also, as a part of the CFM PER Alternative Data Initiative, we periodically organize seminars on data sets and research that are timely, and today's edition focuses on data related to crypto markets. I'm excited to learn how Igor is using it. Back to you, Harrison. Thank you.
Great. Igor, the floor is yours. You have 45 minutes. Welcome.
Oh, great. Thanks.
Why can't I hear this?
Can you hear me?
Yes.
Yeah, perfect. So thanks a lot for having me. Thank you, Harrison, for a nice introduction. Crypto space is an exciting new space. It's no longer a niche market. Last year, the combined value of all cryptocurrencies topped $3 trillion. Many cryptocurrency products today are traded on public exchanges and even included into pension plans. But given that I only have 45 minutes, I won't spend much time today on introduction and motivation. Let me cut to the chase. And today I start with a brief overview of crypto data that can be used in research, and then talk about my recent research that shows how we can use crypto data to deepen our insights about crypto markets. So when it comes to crypto data, we can broadly categorize them into two buckets. The off-chain data, that's the data which are not recorded on the blockchain. Here, the data mainly comes from centralized exchanges and other centralized intermediaries, but they also include some alternative data, such as we can look what's going on cryptocurrency blogs, analyze website traffic, Google searches, etc. The on-chain data, these are the data which are recorded on the blockchain. And in blockchains such as Bitcoin, this data mostly about how cryptocurrencies move from one cryptocurrency address to another cryptocurrency address. But in blockchains such as Ethereum with smart contract capabilities, there the data are substantially richer. They include data from smart contracts, which are the self-executing pieces of code embedded and run on blockchain. So there's the data, therefore, include both the code and the outcome of smart contracts. So if we talk about data from cryptocurrency exchanges, they're very similar to the data that we usually use in finance. Crypto exchanges, they operate very similar to traditional exchanges. Trading there happens via limit order book. So trades are cleared and executed internally. So investor level data are proprietary information of exchanges. Today, both spot and derivatives contracts are very actively traded. Most crypto exchanges transmit current limit order book and transaction data via public APIs, so everyone can freely access them. But usually the information kind of about investors who are behind those trades are concealed. So again, we don't have as researchers access to this information. Some exchanges also offer historical data, and historical data also can be found on a number of public websites. Some of them offer tick level data, and some offer only daily data. Here, for example, is bitcoincharts.com that offers some tick level data. And we also have some specialized data providers such as Geico that offer high quality historical data across multiple exchanges. At the moment, crypto exchanges are not integrated, which means that it's up to users to search for best prices and decide on which exchange to execute their trades. And that feature makes cryptocurrency market kind of a unique and interesting laboratory for studying arbitrage and price formation. That's something that we explored in my paper with Antoinette a while ago. But again, off-chain data are really no kind of different from what we use in finance. So the really new data are on-chain data. That's the data which are recorded on the blockchain. And kind of, as you know, most cryptocurrencies are built on the so-called permissionless protocols, which essentially allow everyone kind of to access data stored on the public blockchains. And to preserve privacy, therefore, the cryptocurrency protocols, they kind of do so by not collecting any information about the users. Cryptocurrencies are stored in cryptocurrency addresses, which are represented by alphanumeric strings and which are protected by cryptography algorithms. Also, the blockchain technology allows for the possibility of a new financial infrastructure where kind of record keeping is decentralized and the financial services are automated with help of smart contracts. Again, these are the small pieces of self-executing code that runs on blockchains. And this new financial infrastructure became known as decentralized finance. And kind of the main intermediaries in this new infrastructure are validators, also sometimes known as miners. They are the agents that validate transactions and ensure integrity of the blockchain. And the other set of intermediaries, well, they're not like really people. These are the contracts, the smart contracts that automate financial functions. So the on-chain data actually allow us to study this new financial architecture and kind of see the behavior of validators, also the efficiency to compare how, for example, decentralized exchanges kind of behave vis-a-vis centralized exchanges. These are really very new and exciting area of research, and kind of we have more and more papers coming kind of addressing those issues. So there are 4 main challenges when we kind of do research in cryptocurrency markets, and they are linked to the design of cryptocurrencies. First, because cryptocurrency addresses are easy to generate, a given user typically controls several addresses. And so for a meaningful analysis, we need to be able to identify these addresses and link them to kind of to the same entity that they belong to. The second challenge is to link anonymous addresses to real-life entities, kind of if we want to understand who are the main players and how the transaction, how cryptocurrencies are used. Still, another challenge comes from processing from smart contracts data. So smart contracts are written usually not in a human readable language, so it's kind of some programming languages. So to process them, we need to know those languages, and that's usually not so easy, at least for us researchers. So we usually need to rely on some industry solution that can process this data and makes them amenable for research. Also, sometimes smart contracts output not necessarily recorded on the blockchain, and so to get the full history of data which is linked to smart contracts, we need to replace the whole chain again, which could be computationally costly. So, but here again, we're just only in the beginning trying to understand how this sector of crypto world works. And the last challenge, it's kind of it's linked to cross-chain analysis. Today we already have many independent blockchains. Usually contracts which are employed on the same blockchain can seamlessly interact with each other. Contracts on different blockchains kind of don't interact seamlessly, or kind of don't interact with each other without frictions, but the industry provides some solutions called bridges that allows to move, for example, some cryptocurrencies from one blockchain to another blockchain. And for questions such as, for example, to understand how systemic risk or how kind of the risk is allocated across the whole universe of cryptocurrencies, we need to be able to trace kind of how contracts work across these blockchains, which again, in many cases becomes quite complicated. Yeah. So they are kind of a broad overview of the data and the issues. Now let me get to kind of one of my research where we show how we can solve some of these challenges and also use crypto data to address some interesting questions. Here I will use my recent paper, which I wrote together with Antoine Shore at MIT. The title is Blockchain Analysis of the Bitcoin Market. It's available on the SSRN webpage and also from our individual web pages. So here we focus on the Bitcoin market, which is still by far the largest cryptocurrency, often seen as a barometer for the kind of whole crypto space. But the methodologies that we develop in this paper can be also applied to other cryptocurrency markets, and we are happy to see that already there are some recent papers that follow our lead and apply our methodology in studying markets such as Ethereum and other markets. So let me first give you a very brief kind of summary of what we do in this paper in case I run out of time and won't be able to go over all results. So there are three major pieces of analysis in the paper. First, we analyze the Bitcoin volume and network structure. So there we show that exchanges are central entities. So the 75% of all volume in the Bitcoin blockchain is linked to exchanges. In the second piece, we study the ownership concentration of the largest Bitcoin investors. We show that ownership is very concentrated. The top 0.01% of investors control a quarter of all Bitcoins and circulation, and this number is just a low bound. Finally, we also study the concentration of miners. These are the agents that validate transactions on the Bitcoin blockchain and ensure its integrity. we show that miners are also very concentrated. And here we are talking about not mining pools, but individual miners. We show that often as few as 50 individual miners control 50% of the aggregate mining capacity. Yeah, so that's kind of the main results of the paper. And now let me maybe get or give you some more details. So first about how we construct our data. So as I said, the first step when we study cryptocurrency markets usually starts from kind of a step where we try to process raw data into something which is amenable for analysis. Here we use a block-side program developed by Princeton researchers to convert raw blockchain data into a database. And so to solve the first challenge of linking many addresses that belong to the same entity, we analyze transaction graphs. And in general, this process is kind of labor intensive. There is no it cannot be fully automated in a sense. So the Bitcoin community, it developed some clustering heuristics that kind of design to solve this problem, but no heuristics is perfect. And so they're kind of what we do. In this paper, we try to be conservative in how we cluster addresses so that not to over-cluster them. Therefore, when we report our concentration results, so that kind of these are always the lower bound for the true concentration. So, and kind of towards this goal, what we do, we start with a most conservative clustering algorithm, the so-called union find. The kind of idea behind this algorithm is that inputs or kind of addresses in the transaction that appear on the left-hand side, like on this graph, kind of on this picture, they all belong, kind of they're deemed to belong to the same entity. And this rule essentially follows from the way how the Bitcoin protocol operates. Kind of to sign a transaction, somebody needs to know private keys of all addresses on the left-hand side. That's essentially true for all transactions except for the new taproot transactions and transactions which are used in the kind of mixing services, but those we exclude from kind of this algorithm, and we deal with them later. Yeah. So, and once we get these basic clusters, then again for important clusters, those that have either large balance or large volume, we kind of look more closely at the local trading networks they generate. So that, again, to cluster them or merge different clusters that we deem to belong to the same entity. Okay. So to solve the second challenge, that is to link addresses to real-life entities, we use here a number of public and proprietary sources. First, we scrape many cryptocurrency blogs and websites for addresses where people share some information that a particular address belongs to one exchange or to a particular player. Kind of crypto community is very active, so a lot of people, for example, following like Celsius kind of default or something else, they would always put some pieces that all this address belongs to that entity, and so on. So overall, by looking what people post and maybe verifying further, we can try to map kind of this anonymous space, kind of bring some light what's going on there. Also, we use the state-of-art database of crypto entities from Bitfury Crystal blockchain, which is one of the leading providers of anti-money laundering tools. This is a firm similar to Chainalysis. So I think we believe that we have the most complete information about crypto entities that have been used in academic research. So we have information about more than 3,500 largest entities. And this includes information about many exchanges, gambling sites, mining pools, darknet marketplaces, and illegal services. So the final step in data construction, essentially, it's more like tailor-made. So to make sure that we do not miss any important information when we study volume in the network, we also look and analyze the top 10,000 largest unknown clusters by volume. And here we use kind of data about known exchanges, about known OTC trading desk, and to infer which of these unknown clusters are likely to belong to exchanges and to other OTC desk, and we kind of label them in this way. We also kind of, for other pieces of analysis, we develop algorithms how to differentiate between clusters that belong to individual investors and some intermediaries. And we also develop algorithms how to trace individual miners from kind of pool distributions. I'll show you an example if I have space later in this lecture. All right, so we have many results, and I will just highlight some of them. So first, we show in the paper that the kind of the Bitcoin design, the so-called unspent transaction output design, and the preference of many users for anonymity, they lead to a lot of spurious volume. And here by spurious volume, we mean transactions where an address sends its balance to itself or to another address, which is controlled by the same entity. So these transactions can lead to congestion in the blockchain, but that's not generally what we usually call volume in finance. Usually in finance, we call volume and those that's the transactions when there is a change of ownership. So we kind of show that the real volume, that's kind of where there is an ownership, change in the ownership. These kind of transactions are only a small part of kind of nominal volume, about maybe 5 to 10%. And that has some implications for how we use some of the statistics of the blockchains. Very often you could see that some literature uses, say, the number of new addresses or nominal volume as a proxy for Bitcoin adoption or for some other economic characteristics. But as you could see, these particular statistics might not be very meaningful unless we take care kind of and separate real volume from kind of this spurious volume. So once we separate the clean volume, we also look at its composition. And here we show that actually the majority of real volume that's essentially comes from exchanges. Yeah. So here the blue line, it's kind of the volume too, and from exchanges and also between exchanges. About 75% of all real volume is related to exchanges, and volume from kind of linked to other entities, for example, miners or illegal transaction, it's only a small part of total volume, less than 3% combined. Here I talk about on-chain volume, right? So there is also off-chain trading volume on exchanges, and these are the different two different volumes. So the on-chain volume happens when investors send their Bitcoins either to in exchange from their private wallet or from an exchange to their private wallet or between the accounts at different exchanges. And what we show in the paper that actually both the on-chain and off-chain volumes, they are actually correlated. The on-chain volume is somewhat smaller than off-chain volume, but kind of overall it's comparable. And these results, kind of, and the correlation between them on a weekly basis is about 44%. So these results suggest that when investors kind of send their Bitcoins to an exchange, that's a likely signal that they are going to trade, kind of to further kind of the coin that they send to an exchange, and that sort of a lot of Bitcoins are stored outside exchanges, maybe presumably because investors do not necessarily trust exchanges to store their coins. It also kind of, these results support maybe a widespread industry practice where industry participants try to keep track of the so-called whale wallets. These are the wallets that belong to very large investors. And we can see that essentially if, for example, a large investor sends Bitcoins to an exchange, it's a kind of maybe a good signal that, for example, they're going to sell those Bitcoins. And given that the market still is not very liquid, it might lead to big price movements. Yeah. Okay. So we study not just volume, we also look how network works. And here again, it's the same idea. Kind of here you can see the largest 25 entities, and essentially pretty much all of them are exchanges. And we can see that even though some exchanges in different jurisdictions like Japan, Korea, the US, but there is a very active traffic between them that has important implications for kind of some regulation, because in particular how we ensure that our anti-money laundering laws work. The problem here, right, that if, of course, all exchanges had the same kind of standards and were kind of in the same regulatory framework, then we couldn't kind of impose strict KYC norms on each exchange, and then kind of to ensure that at least no dirty kind of funds flow to any exchange. But the reality is that not all exchanges are equal. Some of them are kind of in the jurisdictions with stricter regulations like the US, and some more in offshore areas. Here, we kind of, to show what's going on, we also study the network around the Hydra market. That was one of the largest darknet marketplaces before it was closed by German authorities in April. So what you hear on the slide, what you see on the slide is a network kind of around Hydra market. And for simplicity, no, for clarity, I would say more, we only retain nodes that received at least 1,000 Bitcoins within this network. So, and the size of the node that shows kind of, it reflects the volume, the direct volume of Bitcoins between Hydra market and some other entities. So here, for example, you can see three large, the largest both Binance, local Bitcoin, and BitZlato. These are kind of a local Bitcoin and P2P exchange. Everyone knows Binance at the time. I guess over time, it increased its sort of KYC norms, but at the time, kind of the KYC norms were quite lax, and we see that a lot of kind of some investors used this as a means of either taking money to Hydra marketplace or taking money out of Hydra marketplace and kind of getting them to Binance. I was told that sometimes you could even buy already pre-approved accounts at Binance, kind of, and kind of they were sold already in Hydra marketplace, kind of they were bundled products. So, and it seems that, oh, it's only very few exchanges that kind of use kind of channel funds from, for example, Hydra marketplace, but this size reflects only direct transfers. So we know that, of course, in the previous picture, I showed you that there are a lot of flows between Binance and Coinbase. So therefore, what happens once funds arrive to an exchange with a lax KYC norms, then later on, those funds actually go to places like Coinbase, Gemini, etc. So to the extent that we have different norms across different exchanges. Kind of exchanges with a light KYC norms can be used as a gateway to tainted or dirty funds to enter kind of to the whole system. So that's something that regulators should be definitely aware, and that's a serious problem, I think, in this space. So next, let me talk about the ownership of Bitcoin from kind of the very first days of Bitcoin. There was an intense interest of who owns Bitcoins and how much. And kind of there is a so-called rich list of Bitcoin addresses that kind of details how much of Bitcoins a particular address holds. But kind of the problem of Bitcoin ownership is not just a matter of curiosity. I think it also has important implications for regulation, because sort of the concentration of Bitcoin determines who will benefit most, say, from wider Bitcoin adoption. Is it just a few investors or the general public? And the kind of the knowledge of the rich list per se doesn't tell us any information about Bitcoin concentration, because many of these addresses on this rich list, they actually belong to exchanges and other intermediaries which hold balance on behalf of other investors. So when and because most exchanges are centralized exchanges, when investors send their Bitcoins to these exchanges, these essentially Bitcoins, they all aggregated by exchanges and stored in the designated addresses. And so because we cannot pick what's going on inside exchanges, we cannot actually say what is the true holding inside exchanges. So to kind of overcome this problem, what we do is that we do two things. Well, first of all, when we compute the concentration of Bitcoin holdings, we just only focus on addresses that we deem to belong to individual investors and not kind of to exchanges. So it's again, it's a already low bound of the concentration, because there could be some large guys who have large stake kind of on exchanges, for example, exchange owners, or like, for example, MicroStrategy that owns one of the largest now stash of Bitcoins. We still classify this as intermediary kind of address. So, and to separate kind of intermediary and individual addresses, we kind of develop a bunch of a suite of algorithms kind of roughly built on the idea that intermediary addresses should be kind of be much more active, handle much more volume, and also kind of that we shouldn't see that kind of it's not a cold wallet of kind of these guys, that it's not just unidirectional volume from one exchange back and forth, roughly speaking, but the details are in the paper. So here you see the picture that shows the total ownership of all the intermediaries. There was an upward trend until to 2020. By kind of the end of the 2020s, there were about maybe 5.5 million of Bitcoins held in intermediary accounts, which is roughly 30% of all Bitcoins in circulation. We now have more data kind of extended to mid-2022. The trend slightly reversed, and so now intermediaries actually hold somewhat less. So it seems like some investors following decline in cryptocurrency prices took their Bitcoins from exchanges. So this picture shows kind of how individual investors hold Bitcoins, and what you see essentially it's we sort all individuals based on their balance at the end of 2020. So, and then plot the cumulative plot the cumulative holdings. We can see that Bitcoin ownership is concentrated here. The top 1,000 investors controlled around 3 million Bitcoins, and top 10,000 investors control about 5 million Bitcoins. And these calculations do not include the Satoshi Nakamoto holdings. So kind of the early Bitcoins that were mined essentially by, again, presumably by the inventor of Bitcoin, and they are said to be about 1 million Bitcoin. So if we include these investors, the concentration would be even higher. There is some concerns that, well, when we compute this concentration, it could be that a lot of balance comes from addresses where investors lost their private keys because they established they had these balances early on where the price was very low, and so they didn't care much. At least there are some anecdotes on the web page, kind of on different blogs. To address this issue, what we do, we effectively here the picture show you kind of assign a balance, the current balance as of 2020 to a time period when a particular particular cluster transacted last, and that we can see from the blockchain data. And maybe two periods are important here. That's 2004, 2007, because in 2004 the price of Bitcoin first reached 1,000, and after 2017 it stayed above 1,000. So, and if we look, for example, what is the smallest cluster in 1,000 list of the largest investors, or 10,000 list of the largest investors, then we're talking about 900 BTC and 93 BTC. And we see that even if we have like 90 BTC, right, but the price is 1,000, so we're talking about, it's already a substantial sum of money, so that investors probably did have good incentive starting from that time, at least, to keep their private keys in good place. And overall, while it's true that we have some accounts that hold that have not been transacted, say pre-2014, but the total amount is rather small. So in that sense, I don't think that our concentration results are strongly affected by this particular concern of lost private keys. So to give you some perspective how concentration in the Bitcoin market relates to concentration maybe in some other markets, here we look how it we compare the concentration of wealth in the US with the concentration in the crypto markets. And the first to look for the concentration of holdings in the US, we use the paper by Size and Scheinkman, and here the documents that 1% of households in the US hold about 35% of wealth, and the top 0.1% hold 16%. So in contrast, we show that in the crypto markets, top 0.01% of all Bitcoin holders hold about a quarter of all Bitcoin in circulation. And again, if we put the Satoshi Nakamoto holdings, that number would be substantially higher. So overall, I think the conclusion is that the concentration of Bitcoin wealth is significantly higher than the concentration of wealth in the US. Yeah? All right. So in what I have, I guess, 7 minutes, let me briefly talk about miners. So the original design of Satoshi Nakamoto envisioned a fully decentralized world where one CPU equals one vote, but the economics of mining goes against this idea. We know that to mine Bitcoins, miners have to solve a complicated, a difficult problem. Today, the amount of electric power that goes into this activity is really huge. So the probability for an individual miner to essentially to win the race and solve this problem first is rather small, and that creates strong incentives for miners to pull together their resources and co-insure each other. And so mining is done in pools. We can see here one of the largest pools, at least that was back in 2020. The picture has changed so since then, but again, the concentration of pools is still very high. And the concentration of pools attracted a lot of attention. But some observers at least try to downplay this concentration of mining pools, saying that, well, ultimately, it's individual miners that work for the pool. So if one particular pool misbehaves, then miners can just easily take and essentially switch pools and move to well-behaving pools. But I think this argument relies on the idea, again, how easy to switch for miners between pools. And at the end, it does depend also on the concentration of mining capacity. And for this reason, we look at what's going on in this market. We develop kind of algorithms that trace reward distribution from pools to individual miners. Kind of very quickly, this is an example of, say, how ant pool distributes its rewards. So we would see that there would be some reward collection addresses, and then they would pass those kind of rewards to some reward distribution addresses, and then they are done usually via some kind of chain transactions where they go to individual miners. We process this information and we kind of understand who are the individual miners, who are not. So overall, we find that there are 250,000 of miners that received at least $1,000 from mining activity in rewards. And that seems like a large number, but what we show is actually that the mining power is severely skewed in this market. So what you see here are different lines that show how many miners we need to kind of control, say, 10%, 20%, 50% of mining capacity at any point in time. The blue line shows kind of the 50% mining capacity, which can, if you, at least in theory, control that much of the capacity, you can launch the infamous 51% attack on the blockchain. And we can see that quite often, as few as 50 miners control half of the mining capacity. So the concentration also kind of, if we look what's going on and how this concentration varies with the price, then the concentration increases when the Bitcoin price crashes. So what happens is usually the small miners enter kind of mining business during kind of booms when the Bitcoin prices go up, but then they leave the business when the Bitcoin price crashes. So kind of this high concentration, especially may be problematic during downturns in the market. And overall, if we think kind of why concentration matter, well, it's maybe systemic risk. It's easier to take down the system by attacking maybe a few individual miners, but maybe more importantly, because the fewer miners we have, it's easier to collude for these guys, and not necessarily maybe to undermine the network, but maybe to resist some, for example, changes that would be designed to make the protocol more efficient. If kind of the efficiency would essentially make the current trend become lower. Yeah. So I think I'm pretty much done, 2 minutes. So let me now conclude. So what we do in this paper, we show kind of, we use this on-chain block, Bitcoin blockchain data to study the Bitcoin market. We show that overall, this market is still dominated by Bitcoin, kind of by large and concentrated investors. Most Bitcoin volume is for trading activities. Exchanges are the central entities on the blockchain. And I think there are some kind of provide some important issues for regulation, how to regulate this space to ensure that kind of no tainted flows enter the space. Oh, thanks a lot.
So much, that was terrific. There's a lot to think about. Ship stuff is really super important. So let me introduce my colleague Scheinkman, who's going to now introduce the two panelists, and then kind of at the end we'll have Igor along with the other two panelists will kind of participate and answer questions from the audience.
Thank you very much, Chair, and thank you, Igor, for such a great lecture. Our panelists, I introduce them both, and then we'll do in the order. So our first panelist is Agostino Capponi. Agostino is an associate professor in industrial engineering and operations research here at Columbia, and he also directs the Columbia Center for Digital Financing Technologies. And then he'll be followed by Breedt. André is the Vice President for Quantitative Research at CFM. Thank you, guys. Thank you both of you very much for participating in this panel.
Thank you. Can I share go ahead and share the slides, or?
Please.
Okay, let me do that. Okay, can you see the slides?
Yes.
Yes, very well.
Excellent. Let me. Okay, good. So thanks, Harrison, for and Jose for putting together this nice panel. So I want to follow up on the talk that Igor just gave, and I want to present another aspect of crypto market, which is related to decentralized finance. I will focus on questions related to how to design these markets, and also how we can solve problems that arise in decentralized finance, including risk of manipulations due to the governance structure, to the centralized governance structure. So I will not be really talking too much about my own work, although I will mention some of it as I go through the slides, but I want to raise questions, bring up questions, and also provide a perspectives about the use of data, especially alternative data, in the context of decentralized finance, and also what are the problems that I think are important to solve. So let me first start with a very brief introduction to public blockchain technologies. Some of it was already mentioned in the previous talk by Igor, but just for the sake of completeness, I want to mention really what is important about distributed ledger. So these are essentially decentralized systems where the power of validation of transactions is delegated to miners or validators, whose objective is to essentially make sure that the transactions that are being executed are correct and they are performing according to sound principles. And in order to execute these transactions, these validators are rewarded with fees, because that's the way that they get benefit for the work that they are doing. And this means that the users who wants to transact on blockchain, if they want to prioritize their executions, they will have to submit large enough fees so that they get on top of the chain, or that they get on the block, because the block has limited capacity. So not all transactions will be able to enter into the block. And the block, of course, the transactions are executed in batches, every time, every roughly 13 seconds, if we think about Ethereum. The validators who is assigned to append the next block will look at the transactions that have been submitted in this big memory pool. This is the memory pool that the validator has. Each validator is its own pool where you can see all transactions submitted. And this transaction will then be broadcast through the network so that there is pretty much synchronization across the memory pools of all validators. So here I really am focusing on the crypto markets, or the crypto activity that we see on the blockchain. Of course, there is also significant crypto activity outside of blockchain, but that's not what I'm focusing in this discussion. These blockchain technologies have evolved somewhat from what somehow are called, sometimes are called first generation, to what they are called now second generation blockchains. So the difference is pretty much the first generation blockchain is Bitcoin, and these are used to support payment systems or payment transactions between different users. The second generation blockchains represent an evolution and view blockchains not only an infrastructure to support payments, but also a broader infrastructure to disintermediate finance. In other words, what they do is they leverage the so-called smart contracts, which are open source codes, which implement a bunch of different financial transactions that we are used to, such as lending transactions, swapping transactions like in exchange, insurance services. And the key is that all this is happening in a completely decentralized manner, which means that you don't have any middleman who is intermediating between borrower and lenders, or who is providing services for insurance or for swapping. And like of course, decentralized finance has emerged in the mid of 2020, so it's a relatively recent phenomena, relatively recent market financial innovation. Nevertheless, there is a belief that this could be one of the killer applications for blockchain technologies. Of course, the market design is not perfect yet, and this is what I'm focusing on here. But there is a lot of discussion and a lot of promise for DeFi to become really one of the mainstream applications in blockchain and in finance. So the ecosystem is split, more or less in terms of volume across these different services. So it accounts for about 48 billions in total, at least according to the last quarter that I've checked, which was the second quarter in 2021. It has evolved since then, but this basically gives you an idea that it's like a significant market share. It's roughly between 10% and 30% of the total volume or the total traded volume in the whole crypto ecosystem, which means that centralized finance is still like the predominant part of the crypto space, but DeFi is now accounting for a non-negligible fraction that deserves attention. And there are, as mentioned, several services that are being implemented, including decentralized exchange, decentralized lending and borrowing. So you deposit tokens into a pool, and then those who need to lend, those who need to borrow, will come to your pool and get their tokens. There is also services that perform insurance or derivative transactions and so on. And there are oracles who are feeding information from off-chain to on-chain. So they take information, for example, from one of the main centralized exchanges, Binance, about exchange rate being Bitcoin and Ethereum, and feed this information into the centralized exchange so that we know what is the price at which transaction should be conducted. Okay, so that you can see there is a lot of data that is needed, because in order to interact between off-chain and on-chain, like you need to access data, and you need to make sure that this data is flowing through the DeFi ecosystem. So the key characteristics of DeFi, I think there are like several benefits, and of course, but if I have to mention two, I would mention transparency and of course decentralization. Transparency is because the information is pretty much available both on settled transactions, but also on pending transactions. And the protocols are also open source algorithms. So if I want to see what protocol is being implemented by a decentralized exchange, I can go and look at the code, and I will be able to understand exactly what it's doing. The code is, of course, not ambiguous, and I mean, it cannot really be strategic, right? It's a mechanical code that executes transactions when some conditions hold. And the settlement is instantaneous and enforced by the smart contract. So when the transaction is confirmed for execution, like there is an exchange of tokens from the seller from the buyer to the seller, or from like the lender to the borrower, etc. Then the decentralization is the other characteristic, which is made possible, of course, by the underlying infrastructure, which is blockchain. And this is, I think, the decentralization, of course, presents risk, as we have seen from the previous talk of Igor, especially at the level of the consensus algorithms, where you can see that most of the token, the amount of wealth in the system can be concentrated among a few token holders. But I also want to bring up another important risk that arises in terms of governance, where we could see that like those token holders who have the wall tokens, which gives them the right to vote, might basically be excessively concentrated only on a few participants. Of course, this is also concerning if like 2 or 3 governance token holders will have the right to vote and make important decisions on protocols and services. So let me show you some snapshot about really what is happening when you confirm a transaction or when you submit a transaction. So all the transactions that are confirmed they carry a lot of information. For example, you know their status, you know what has been the specific transaction. In this case, it has been a swap between the Alice token, which is a token like that enabled an Ethereum token, which enables you to play like multiplayer video games. And this token is being swapped for Ethereum. And this is happening on Uniswap, which is the largest decentralized exchange. You know a lot of information, like you know from which digital address to which digital address there has been the transfer. You know what is the smart contract that has implemented this specific transaction, and you also know what is the fee that has been paid in order for these transactions to be validated by the miner. So I mean, this is really the alternative data that we have on blockchain that we use not what we didn't have right in traditional like centralized limit order book, for example. Like this is all very useful and important information that can be exploited, like both for like providing to get trading signals, but also like more generally to understand whether or not like you should transact in the next block. And I think even more, yeah. Sorry, I couldn't hear very well.
10 minutes.
How many minutes do I have?
We have another minute.
1 minute, okay. Yeah, so let me go ahead. So we also have the transactions are, I mean, there is transparency for pending transactions. So you can see essentially all transactions that have been submitted for execution, even if they have not yet been executed. You know what is the fee that they want to pay, you know from which digital address to which digital address they want to go, etc. And you can also see the transparency of the smart contract. So the code that is implementing the specific functionality. So just to make the point that there is a lot of room, especially for a company like CFM, to define data analytics, like how can we rate, for example, different DeFi pool or tokens like we did for bond and equity. There are also some unintended risk that needs to be quantified. For example, in a paper with Zhang, we have shown that exactly on DeFi, liquidity providers can be exploited by arbitrageurs under the current design, and therefore they may end up losing a lot of money simply because there is a lot of room for arbitrage between off-chain and on-chain. There are other unintended consequences. For example, like you can see pending transaction and therefore you can front run them. If I see that Arizona submitted a transaction to buy, I will basically submit a transaction to buy with a larger fee so that I prioritize my execution and I will then back run him. And this risk is like huge. And this is one of the main problems that we have in the public blockchains. For example, like about 90% of the blocks contain transactions which can be front run, and each front run is basically making on average 0.2 Ethereum, which is a substantial amount, like about $300. Like we have basically looked at possible way of mitigating front running risk. One possibility will be precisely to go to privacy preserving pool. So it's like dark pool where the user submit their transaction directly to miners. But what we have shown in this study is that this will not solve really the problem, because the miners, the validators, may prefer to monitor the public pool to preserve this so-called miner extractable value. Like if I go to a private pool, then I will not seek any more competition between arbitrageurs. As a result, the fees, the revenue that I will make is smaller, which leads basically to other possible solutions for these problems, which can be at the protocol level. For example, the so-called zero knowledge proof. And like I wanted to speak about DeFi governance and risk. I mean, I will just mention briefly that governance token holders were the one who are making voting decisions, typically are very concentrated. So if you look at the Maker top 100 token holders, the one of MakerDAO, which is one of the main DIO in blockchain, you see that the top 3 token holders hold more than 50% of the entire amount of governance token in the system, which again leads to risk of manipulation, risk of embezzlement, etc. So it's, I think, a concerning problem. I think we can see exactly how, especially because the information is public, we can see all this concentration of tokens in blockchain. And I think this is another risk that needs to be addressed. And I will stop here.
You know, our next panelist, Andre, is, I think, is ready to go.
Yes, good afternoon.
Yeah.
Good. Can everybody see my screen?
Yes, we're here.
So yes, hello everyone, and thank you both to Igor and Agostino for very thorough presentations, and thank you also for Columbia in organizing this event. We are always very happy to participate. The reason I'm here today is to give a perspective from the point of view of an asset manager. Or specifically, I should say, from a hedge fund. So In order to structure this very briefly, I thought it's best to explain how we view crypto and cryptocurrency and the entire ecosystem through two different unique lenses. And the first obviously is using or looking at crypto through the lens of an asset class. And I will show you a few statistics around how the hedge fund industry views and ourselves view crypto as an asset class. And the second lens is alternative data, which is the topic of this conversation, which Igor has mentioned already, some of the alternative data, which I will briefly review and give a use case of how we at CFM think about using some of this alternative data. So to kick it off, viewing crypto as an asset class. So it goes without saying that there's been an incredible buzz and excitement about crypto, and it is an infinitely complicated topic. But for some other reason, it has not necessarily translated into tangible AUMs amongst hedge funds, at least, as one might have imagined. So what I wanted to show is just a snapshot of where the hedge fund industry is in terms of managing and investigating and trading the crypto as an asset class. So you can split this up into two categories. One, those hedge funds that have a very specific mandate in trading crypto, and those traditional hedge funds range with all the different strategies and ranges. As for those hedge funds that trade specifically in crypto, the AUM as of 2020 is in the order of $4 billion. So if you take this in perspective, in terms of the AUM managed by the hedge fund industry at large, which is about $3 trillion, it is a relatively tiny amount. Which is another interesting factoid is the type of investors that invest in these very specific crypto hedge funds. And if you look at the breakdown by investor type, you see that by far the largest investors are high net worth individuals, around 53% on average, followed by family offices. So the large public pension plans, corporate pension funds, etc., does not seem to constitute that big a part of the investor type when it comes to those very specific crypto hedge funds. Moving over to the more traditional hedge funds, and if you look at the assets that they manage, how they gain exposure to cryptocurrency or to crypto, and also the reasons for investing, you see that assets under management, even amongst traditional hedge funds, are pretty benign. Of the managers managing less than 1% of their total AUM in crypto is about 57%. So much more than half of the managers have less than 1% of their total AUM in crypto. How do they gain access and how do they trade? Well, typically through the two most recognizable coins, namely Ethereum and Bitcoin. 67% of hedge funds access them or trade these coins, and then a few other cryptos. How do they gain exposure to these? Well, typically through the most liquid markets. And this is the future and option markets. And then it tails off towards some more idiosyncratic markets. And when asked why hedge funds invest in crypto, the most often reason cited for investing is for diversification purposes. So all of this to say that the relatively small amount of AUM managed by hedge funds today is for a bevy of reasons, that we also recognize, and I've listed a few of them here. It's not an infinite list, but it's obviously regulation, first and foremost, and not only uncertainty about existing regulation, but also regulation in the future. Then are obviously some cross-border accounting and tax considerations, counterparty risk, There's also the fragmentation in the market, which Igor highlighted, and then liquidity. So liquidity, apart from the liquidity that can be found in futures and option markets, which is sufficient, the other markets have liquidity that is, let's say, spotty. So this is a snapshot of where hedge funds are in terms of trading and the levels of AUM. Some other features that I wanted to quickly highlight, and I think many of them have been well documented in mainstream and financial media, but nevertheless, and one of these is the increased correlation of crypto to benchmark asset classes. And what I did here to illustrate this, excuse me, is showing a difference of two correlation matrices, a correlation matrix before COVID and post-COVID. And what you can see in the bottom where I highlighted in red is the difference between the correlation of Bitcoin and Ethereum in this case to major benchmark asset classes pre and post-COVID. And as I said, has been well documented, is there's a market increase in correlation between especially Bitcoin and equity markets, but also most other mainstream benchmark asset classes. Now, this obviously draws into question some of the diversification potential if you are investing in these cryptocurrencies. And moreover, given that most hedge funds, traditional hedge funds, cite the increased diversification as an objective for investing in these assets, is also being drawn into question. Another feature which is quite interesting to note is on the right-hand side here, I simply plotted the average cross-correlation amongst major coins. So what it is really is how do these, and in this instance, I took 12 coins that are that have price quotes in USD, and you look at the evolution of the average cross-correlation amongst these major coins. And you can clearly see there's an increase of this average cross-correlation since 2015 up until very recently. And this average cross-correlation is at a level of about 70%. So that is just a snapshot of some of the features and how hedge funds and ourselves view cryptocurrency as an asset class. But a bit more interesting, I guess, is the second lens through which we view crypto, and that is the wealth of information and data that you can extract or that you can access from the crypto ecosystem. And a few things that I wanted to briefly highlight is what this data is, and Igor has mentioned some of this already, and what you can do with it. So if you look at the exchange data, simple. So you can use this data to develop crypto-based indicators of sentiment. So in addition to some of the work we do in creating sentiment indicators to give a sentiment of market risk, we can use crypto to do exactly the same and compare. As we do at CFM, we can use correlation and other statistical methods to monitor the evolution with more traditional asset classes across a wide range of coins. And we can also build crypto-based strategies, which is giving us an insight into traditional asset classes in addition to our various other strategies. And this is something that we do at CFM. Another sandpit, if you will, in which we can extract information that we can use in trading traditional markets is looking at order book data. And I just put a snapshot here of a paper that was written by Jean-Philippe Bouchot and Jonathan Dornier, where they investigated the Bitcoin market and looking at the order book and trying to glean more information and an understanding as to why markets crash. And Bitcoin, and I will not delve into this because the time is running out, but has got unique features which is orthogonal to traditional financial markets. Nevertheless, the way that trading is done, the looking at the liquidity, these give us insight into other markets where we can draw statistical conclusions where we can use for trading in traditional financial markets. Again, apart from exchange data, there's the off-chain data that Igor mentioned, and he saved me some time. So, yes, 1 minute.
1 minute, thank you.
It will do. So I'm not going to repeat many of the data that was already mentioned, but I will give you an example of something that one can do, for instance, and that we have done at CFM, is using textual analysis. So what I show here is looking at an enormous stream of data, news, social media, etc., and looking at the co-occurrence of key terms. So in this case, we looked at the co-occurrence of Bitcoin to various commodity futures. Now, I use commodities purely for illustrative reasons here. You can easily use this for other markets, entities, companies, etc. And then you can track the co-occurrence of how often is Bitcoin mentioned to, in this case, commodities. Clearly, you see that there's a very high and stable co-occurrence between Bitcoin and gold, for instance. And one can speculate as to why this is. It's safe to assume that it's typically chatter about the store of value argument, say. But nevertheless, this is one example out of many where we can extract data from various sources related to Bitcoin to inform us on trading in traditional asset markets. I will leave it there.
Thank you very much. So now, I think the audience has been sending some questions. You can open up. Yeah. So, but before we do that, let me start with a question that I think it's interesting. It wasn't really the focus here, but which is right, because you guys covered a lot of stuff. In any case, the fact that you've got, if you look at Bitcoin as mother of all cryptocurrencies, a lot of competition to Bitcoin has appeared over time. So even though Bitcoin has its own method to control supply, the aggregate supply keeps going, which keep creating new types of crypto. So I'd like to understand, and then there is this more novel thing, which are the central bank digital currencies. So of course, none of these cryptocurrencies are very much used for transactions, so that may not really matter very much. But in a sense, they were designed to be used for transactions, and but a lot of transactions are now the central bank digital currencies, which are basically free to trade on. So I want to know, what do you think that's doing to the market as a whole? And we start, whoever wants to answer it, otherwise I'll point someone.
I can take a stab if I don't know. I mean, I can share some tools that I have, and then of course open. So I think, Jose, if I understand correctly, you are asking, okay, why Bitcoin has, despite there has been a lot of supply of tokens and a lot of new tokens being minted, like Bitcoin is still like remaining the dominant currency in the market, right? And also, like, why do we why wouldn't we observe maybe a drop in the price of Bitcoin if we see many other competing tokens being created, including the CBDC? So I mean, if I understand correctly, that my take here is that the price of this cryptocurrency are really based, in my opinion, on the sentiment, on the belief, on like this. I mean, the signal that there will be a large boom in the crypto market. So if we think that, if we see that there is a lot of new tokens are being created, if we see the increased supply, I think this is good news for the crypto market. And all these currencies are pretty much moving together, so they are very correlated with each other. So that means that if like we foresee that the crypto market is expanding and we see many new tokens being created, I think this is positive news for Bitcoin. In fact, I think what we have seen is that when the market share of Bitcoin has gone down, because there have been a lot of new competing tokens being created, including like stable coins and issuance of CBDC. Despite this, like I think the price of Bitcoin has actually gone up. So it seems that to me there is like positive correlation between supply of tokens and prices of Bitcoin.
I can add something if you wish. So actually, I have a slightly different view, and what we show in our recent Brookings paper with Antoinette, where we provide an overview of decentralized finance and kind of more generally of the crypto space. So even though we have new cryptocurrencies introduced, it's actually the existing large cryptocurrencies, they often impose negative externality on the security of the newly introduced cryptocurrencies. And kind of to understand where it happens, right? So for example, if we think about proof of work protocol like Bitcoin, so what matters, right, is, well, how easy to get this 51% kind of share. And in general, because you have to be compensated for the power that you spent on kind of on mining, right? So there are no kind of inherent disutility of accumulated a large stake, because again, at the end, you have to be compensated, at least on the equilibrium path when you kind of accumulate this particular mining capacity. So now if we look what happened actually in this space, well, Bitcoin was kind of growing, and the electricity and whatever computing power in Bitcoin kind of space, it grew up a lot. And so nobody generally has a lot of, even though the computing power is very concentrated as we show, but still, kind of we don't have one party that controls, say, 51%. But nevertheless, there are still kind of some excess capacity in this market sometimes, especially when the Bitcoin price goes down. And so we have marketplaces where people can rent this computing power and actually use this computing power to, for example, kind of mine some other cryptocurrencies. And because other cryptocurrencies, they're small, right? They're still in the fledgling state. So there is not so much of the computing power spent there. So what we saw actually is that people use this small fraction of the Bitcoin power kind of in the free market to grab a little bit, but that's again small relative to the Bitcoin market, but it was very large compared to all crypto, all the computing power used in some other coins, and there were many attacks on other smaller coins. And kind of similar, actually, security problems exist even for not just proof of work, but also proof of stake. If you think about, usually the industry focuses on the idea of whether there would be double spending attack, right? So where the incentives kind of, we think, oh, to attack a particular blockchain, right? If you have a large stake, you cannot benefit a lot from double spending because it's just a small fraction of the total balance of this network. But if you think as a multi-platform competition, like people like Ethereum or whatever, right? When they see some new fledgling rivals that might overtake them in the future, now you can see that actually incentives start kind of compromise those competing networks could be substantially larger. And so then again, network externalities, etc., right, on top of it. And if we think where we want to invest more, do kind of, if we already have Ethereum with a very large infrastructure of projects, etc., and kind of consumers things or like users think that it's a secure network, right? It's very difficult, I think, to compete with already existing guys. So even though lots of cryptocurrencies are introduced, right, but I think because we have this endogenous constraints to competition, even though again it's a free entry, but like the normal kind of network externalities, economies of scale, and again, security concerns, they might actually pose barriers for this new entrants. And so we still kind of the winners takes it all kind of where just a few cryptocurrencies dominate the space.
Thank you all and thank Agostino for contributing to this answer. So let's go to one of the questions has been made. I think Andre has already touched this on this question, but Yanis Sibigatis is asking. Sorry for if I. He's actually asking. You know, if you look at a hedge fund which is doing some crypto investing, how much do you think of it's being dedicated on average, or the model is that being dedicated to crypto? And what do you think should be the minimum percentage before they can make their diversification assertion credible?
It's a very good question with, I dare say, unfortunately, not a very good answer. But I think as I showed, there's clearly this emergence, although perhaps not very sizable emergence of very specific crypto hedge funds. Now there's in the range of some estimates put it 300 to 400 unique hedge funds that trade in crypto. But the average size, if you look at these individual hedge fund cryptos, are relatively small, in the region of $30 to $50 million in AUM. Now, that is the crypto specific hedge fund side. In the traditional hedge fund space, now, again, I think it's no secret on the street that various hedge funds are investigating and claim to investigate in trading in and investing in cryptocurrencies. But again, the data shows that at this stage, a vast majority of the hedge funds have a very small allocation to crypto. And as it relates to how much you need to add in terms of gaining real diversification, well, again, there's the two problems of having to trade at real size if you are a large hedge fund manager to get any diversification potential. And if you've already have a very diversified portfolio, adding one additional say contract, if you were to trade the Bitcoin or Ethereum future on the CME, even if you were to add that, you have to look at the correlation, and you also have to look at how much size you can put on there. So if correlations are increasing between, say, traditional asset classes, equity futures, for instance, and this increase with to the futures you can trade on the CME, your diversification potential mechanically lowers, and also you cannot put enough money on it. So that is, I think, the best I can come up with. So in terms of putting a number on it, it's very hard to tell.
Thank you, Andre. I think Harrison has a question.
Yeah, so I thought it was fascinating, all of the discussions, the lectures that seem to kind of be pushing that this sort of this crypto 2.0 on the public blockchain is combining both, you know, what you would call, you know, asset class, kind of a new asset class like gold or you know, like art, into some alternative asset class with what is essentially smart contracts, right? You know, that's meant to disintermediate banking or insurance or some other types of real estate. You know, trying to get rid of some of the rents that are kind of in the financial system. So do you have a sense of why you think, I mean, just, I guess it's for all three, of how you think this will evolve? I mean, just first, why is everything being kind of bundled together? Like in terms of like, you know, when you're doing a DeFi, you're kind of, there's a bunch of currencies that you would trade. And then there's also some smart contracts that are associated with those currencies, I guess, right? Where you kind of validate it. and the various transactions. So do you have a sense of why everything is being bundled? Is it kind of technology? Is there some economic reasons for why there's this bundling of what seems to be very different functions in the economic or the financial system?
Well, I guess one answer to your question would be, remember, if we are really in this, want to have decentralized finance, right, in a way like this permissionless, open, kind of for everyone blockchains, right, then there is a security about the blockchain, as I already outlined, right? You need a way to secure this blockchain, right? So if you start building different blockchains, and it's very easy to have private blockchains, right? Or in a way where not kind of permissionless, but permission where we say whatever, 100 guys can enter and only they, we can kind of say that if you satisfy particular criteria, accountability, etc., everything will be super efficient. We can have probably different networks that serve some purpose and maybe ensure interoperability between them, right? Kind of with this, some standardization of kind of how they should be built, kind of in APIs. Here, right, the industry really kind of wants to have this permissionless protocol, and that's kind of where we have a lot of problems with securing and sewing, right, how kind of anonymity and so on. So that's why having kind of, again, Ethereum, for example, right, because we know it's secure, it's very large and so on, tested one, I think that's what, again, creates this sort of almost the winner take it. Oh yeah, we can try to build maybe something else, but that something else might not be secure and so on. And again, if you think about the security of applications built on the Ethereum, right? So in a way, the security of application cannot be more secure compared to the security of the blockchain it builds, right? And then again, that's another constraint on how you and where you build your application. So that's at least one consideration where I can see why where they live on the same blockchain.
Anybody else who's interviewing? Otherwise, I'll go to the next question.
I think just another perspective that I want to add back to what Harrison was asking, why are we bundling all this together, right? I think two advantage that I can see is first of all, like you have this you make transactions very atomic, which might reduce like the intermediation cost. For example, in the same transactions, I could borrow through a flash loan on DeFi, and then I can use the amount that I borrowed to perform, for example, an arbitrage transaction on a decentralized exchange. And like in traditional financial, I mean, if you don't do this, if you don't bundle this together, then you would have to separate the services. First, you need to borrow, then you have to make another transaction where you deposit the amount that you've borrowed, or you use the amount that you've borrowed to purchase a token. And of course, this might be more costly. So in terms of like reducing intermediation costs, but also in terms of like having faster settlement of transactions, I think this interconnectivity and the interoperability of services greatly helps.
Agostino, I want to, somebody, John in New York City, asked a question. I'm going to rephrase it a little bit because it's kind of an important question. So if we think that in general, the decentralized finance and crypto world is going to grow, okay? It's interesting to know, and we know that some of these protocols, one uses a lot of energy, right? One uses a lot of electricity. So the question is, there's something about the amount where we are right now, which is the average consumption per contract, whatever, or total consumption of the different categories. But the second thing, which I think is more interesting for an economist, is that if this grows, what's their marginal use? Because it's not only the average, the past is fine, but we're interested in what's going to happen in the future. I'd like to know what would be the marginal use of electricity that these developments that are going on in crypto and decentralized finance are going to demand, and how much of that could come from renewable sources, or how much that comes now from renewable sources.
I already sent the link. I think Cambridge University, they maintain this an index where they try to estimate electricity consumption because we know the hashing power, we know how much goes in a particular kind of a hardware unit. So observing hashing power gives us quite good idea of how much electricity is used. I think, again, the estimate's about 0.5 percentage point, but I think there are two things. Yeah, Bitcoin, first of all, it's inefficient, but it also, again, why a lot of people invest in Bitcoin, right? But in a way, it's a bit puzzling because if anything, it's probably protocols like Ethereum with smart contracts where you can do something else rather than just speculate and essentially transfer coins from one investor to another, right? Build some application. I think they are more interesting in a way. And you could see that they just accomplished what is known as a merge, right? They moved from kind of proof of work protocol to proof of stake protocol, right? So the majority of new protocols, second generation or whatever, they don't use a lot of electricity power in that sense, precisely because that was a concern, right? And then we can talk about proof of stake, what are the issues, kind of delegation incentives, and actually we have some work with Antoinette that kind of we study those incentives. It's an interesting question, but at least electricity consumption is not an issue for those protocols, and that's, I guess, all decentralized finance is built on protocols which use proof of stake and not proof of work. So in that sense, the question does not apply to, I would say, almost to the
For
future.
the future, you think there's not going to be a problem? Whatever's happening with Bitcoin is like a fix.
Again, I don't know what's happening with Bitcoin, but that's pretty much the only one. Kind of the rest are tiny, and everyone else moved to proof of stake. That's where we are.
Yeah.
I think unless you can go get one more answer, but then
Any last comments? I think we have to sign off.
I think I wanted to add, I completely agree with what Igor said. Like the switch to proof of stake is actually removing a lot of these concerns. Like in terms of proof of work, I also want to add that if you look at, let's say, the efficiency of the mining hardware has improved tremendously. So in a way, like they're able to mine like at a much faster, I mean, with a much higher efficiency, which means that the energy consumption that they are using actually has gone down, and partly is due to the use of renewables.
Thank you so much, Igor, Andre, Agostino. This was really fantastic. Thank you so much for doing this. Adam, are you there? Otherwise, we're going to sign off. Just to announce, we will have the YouTube video and the slides posted on a link in our Columbia University's CFM PER webpage. So you can look for that, or you can just email one of us to send you the link. Adam, any last words?
Just like to thank the Igor for the presentation and panelists for their insight. And it's always interesting to see how we can use data, leverage data to study different markets and different aspects of finance. Thank you, everyone.
Well, thank you all.
Thank you.
Bye.
Bye.
Pleasure.
Bye-bye.
Thank you, everybody.